Hello, welcome, bonjour. My name is Rachel Bailey. I'm with the Canada Trust Company. We are the corporate trustee of the Métis Nation of Ontario Prosperity Trust, and it is our honor and pleasure to be able to present and speak to you and provide an update about the Prosperity Trust today for your annual General Assembly. We'll talk a little bit about the trust, give you a quick financial update, and then we'll hear from our friends at TE Wealth, the independent financial advisor, Jack Jameson and Kane Big Canoe, talking about a little bit more about the actual performance of the underlying actively managed portfolios within the trust. Let's start by giving you a quick financial update. Just as a reminder before we begin, a trust is a relationship. This trust began in 2018, and it has been invested with $27,500,000 initially. Your trust agreement comes with lots of rules that you've set out. You've customized your agreement that meets the needs of your community. And it's our goal to try and work with you based on the terms that you've provided, to adhere to the terms that you've provided to us and make sure that there is, over the long term of the trust, prosperity for you and your citizens. The trust will last for more than 100 years. So it is certainly a relatively new trust. And over the course of the years, we're going to see ups and downs in the markets. Unfortunately, most recently, the markets have been a little bit down. We'll talk a little bit more about that shortly. But just to say that we do expect over the long time that this trust will produce benefits for you and the citizens and for future citizens as well. So as I mentioned, we started actually with a $50 trust, $50 bill. There was $27,500,000 contributed to the trust, and as at the end of December 2021, the market value of the trust was $31,863,730. The most recent update we have shown here is to August 8th, 2022, and the value of the trust was $30,228,593. So it's dropped a little bit. And we'll talk a little bit more about reasons. Certainly, I think Kane and Jack will speak more about some of those root causes, but there's things like inflation, the war in the Ukraine, supply chain issues. You can see all kinds of headline news. What we do expect over time that there will be recovery. And the fact that the market value is down is really just a paper loss. We do expect over the long term that we'll continue to see growth in the portfolio. But if we do take a look at what was initially contributed to the trust and compare that with the current market value, there's been growth of 2.7 million. And in 2021, we made an income payment to the Métis Nation of Ontario through the PCMNO of $860,540. So in total, the net benefit or total contribution has been a little over 3.5 million. Just to say that even though we are experiencing some rockiness in the market, there are a lot of eyes on the portfolio. So the Canada Trust Company, as your corporate trustee, has responsibility for the day-to-day management of the trust. And we are to deliver the benefits to the beneficiary of the trust, who's defined as the Métis Nation of Ontario Secretariat and its successors. The eyes on the trust include our financial advisors through TE Wealth, which is an independent company separate from TD. We have the accountant, Baker Tilly, the services provided by the accountant, Benoit Gru, and the investment managers. So there are two active managers, Butel Goodman Investment Counsel and Moore Investment Management. There's also a third component to the trust, which is a promissory note with Bright Roof Solar, and that promissory note is worth a little under $5 million. So when we get to our numbers and you compare them against the TE Wealth numbers, there's a difference, and that relates to the promissory note because it's not actively managed. That's just something that we as trustee keep an eye on and make sure that payments are collected. We thought we'd provide you a little bit with a year-to-day update. So certainly behind the scenes with respect to the income and expenses, there's lots of day-to-day activity. Even if the markets are down, there still is income coming into the portfolio, both through dividends and interest and capital gains. In your definition of what you constitute in your trust as income, that also includes unrealized capital gains. So if we bought a stock and we sell it, that's an actual realized capital gain if there's a gain to be reported. But if we haven't sold it, that's an unrealized capital gain. So this definition of revenue actually takes into account any growth in the portfolio. So we can see that year to date for 2022, we are at $425,326 in income. We have had expenses so far year to date of $166,741. And usually trust expenses are expressed as a percentage of the market value of the trust. And currently we're at 0.55%, also in the industry called 55 basis points, which is well below the general threshold of keeping expenses of a trust to this size to less than 1%. So I don't think that there's anything particularly remarkable about the income or expenses going through the trust portfolio right now. They are as expected based on expectations that we see for regular income production and regular invoices. Know too that a lot of the professional advisors' fees are based on the market value of the trust. So we are also, our interests are aligned to make sure that the trust goes up in time. I've included here the 2021 figures just for comparison. We went through audited financial statements through Baker Tilly, have a clean audit opinion, and the expenses and revenue are shown here. So revenue in 2021, 2.3 million, and expenses 250,000, or overall about 79 basis points or 0.79%. So again, comparing that to 2022, we are on track. One of the key benefits that comes from this trust is the ability to make payments. And you have a very specific definition in your trust agreement as to what will trigger a payment that comes out of the trust. There was a payment that was made for the 2020 year end in 2021. There was no payment made for the 2021 year end made in 2022 because the calculation didn't allow us to be able to make a payment just based on the various factors that go into your calculation. One of the biggest influencers on your payment and the ability for us to be able to have income available to distribute is what the inflation is and what the growth is in the portfolio. And I'm sure you've seen in recent headlines in Canada, inflation in June was 8.1%, which means that it is keeping the, it means that we have to surpass inflation and have very positive market growth in order for us to trigger a payment and take into account a lot of other factors here. So I've shown a little sample here. I won't go through it in detail, but just to say that when we are able, in accordance with the definition in your trustee, to make a distribution, we absolutely do that. And we note the payment here for 2021. When a payment does come out of the trust, it is to be used for the economic prosperity and self-sufficiency and the long-term wealth creation of the Métis Nation of Ontario citizens. And so when the money comes out, there are to be either proposals reviewed, which are evaluated by the PCMNO, or there could be other PCMNO initiatives based on whatever the priorities of the MNO and its citizens would be at that time. So I've included a little bit on the considerations just to say that, again, we hope that there are regular distributions that come out of the trust. We do hope for brighter days in the markets. And again, this is just a point in time update for you. Where it really matters is at the trust year end, which is December 31st, when we'll go through the process of going through audit. The trust is compliant with your rules and regulations. And again, it's a dynamic trust with lots of moving pieces, and we'd be pleased to answer any questions that you have. So thank you, Marcy Miigwech. And now over to TE Wealth to provide an update under the hood a little bit more on the performance.
Greetings, folks, and thank you for allowing us to join you today. And thank you, Rachel. The information is always interesting from your perspective. And again, to everyone, hope everybody's well. And we want to thank you for allowing us to join you. And it goes without saying that we're extremely honored to be able to support the MNO Prosperity Trust on behalf of TE Wealth's Indigenous Advisory Services. My name's Jack Jameson. I've met many of you, but good to see everybody again. And oh yeah, there's this other guy with me here, Kane. Somebody who's that? Oh, Kane, who are you?
Hi everyone. I also think I've met most of you, but honored to be here today. My name is Kane Big Canoe. I'm a CPA by trade and the Associate Vice President of TE Wealth's Indigenous Services Practice. So You're going to hear from me in a few minutes, but hand it over to Jack and we can get things started.
No, that's good. No, it's great. Thank you, Kane. And we'll kind of go through here and we really want to kind of bring you up to date on the status of things. This is an AGA as of the end of the 2021, December 31st, but we also obviously would be permissive to talk to you. I think what most people are wondering is, gee, how have we been doing in the new year, given all the noise that's out there? So one of the first things that we really want to talk about, and you maybe even seen this slide from us before, but what are we, there is a trust agreement, which is the rules. But from an investment perspective, what are we really trying to accomplish? And that's, I guess, from our perspective, it's really, I think, meeting the needs of the present without compromising the ability of future generations to meet their own needs. And that's very important. It's about balance. And we do have needs in the current. And I always like the Warren Buffett expression down at the bottom of this slide. Somebody's sitting in the shade today because someone planted a tree a long time ago. Someone's sitting in the shade today because someone planted a tree a long time ago. It's thinking about the future. And that's really, it's a balancing act, I guess, about, as we say, doing good things today, but also making sure this grows for the future. And the next slide really just kind of hits, the dollar values. As of December 31st, we saw a little bit from Rachel as well. If you look over the circled area there, clearly, over since inception, which has been back, I guess, really the third quarter, September of 2019, so a little over a couple of years, we're up $5.3 million at the end of December. Not a lot coming out, so it's really a growth strategy. There's no question. If you look at the 1 year column down under the appreciation, the third line down, just over the year, $2.5 million. Not a bad year in 2021 for sure. And even over the quarters, about $760,000 over that fourth quarter of 2021. So it's been pretty good. The next slide really just talks about the asset mixing. It's just a reminder for those of, in the sense of the strategy. I guess we want to make money, but we don't want to take additional risk or extreme volatility. When you look at this chart, you can see visually the pie chart. There's a lot of different colors there. So we are very much diversified. That's important. No one color, no one asset class reigns supreme through all environments. The middle column there, I guess the second column from the right down at the lower end of the chart, kind of shows you, if you add all it up, the target that we give to the managers is, hey, we kind of want to hang out around 55% in stocks and about 45% in cash and fixed income or bonds. And one thing you will notice over the far right is under the cash equivalents, the top of that far right column, about 9% or so in cash equivalents. And that's probably a bit symbolic of the cash serves a couple purposes. One is to, opportunities for the managers to buy new opportunities, but also given perception that, things are changing here and they were sort of building up a bit of, a defensive mechanism here, I think. But typically, if you added all that up, you are in and around 55% equities, technically 54.4%, and you're about a little bit slightly 0.6 overweight in the fixed income cash. So they're compliant, everything's good in that front, and it's a balanced portfolio. The next slide really talks about the performance, and again, all is good. If you look over since inception, you see the three different lines down below, the actual Prosperity Trust return, the market benchmark, and the target return. So what's all that mean? Again, one, we want to make sure that, we talked about our objective of doing good things today, make us some money today, but grow it for the future. And clearly on that inception column, that blue column, you can see in all case, it's above the market and over since inception, 10.1% since we started. And the market's up 9.3%. So check, that's pretty good. Target return, we do want to make inflation plus a 3% dispersion rate. And sustainable withdrawal rates are in that 3 to 4%. And that's very important that we make enough money to pay expenses, to do sort of good things today, but also grow for future, in keeping in mind the inflation rate. So again, back since inception, the inflation rate's been fairly modest. You can see over the year, once again, 11.3% ending December 2021. The market's up 10.1 and beating that inflation rate plus the target rate, which is, again, so far so good, at least in 2021. Things, as Rachel's talked about, inflation is, up 8% above, and that has put certain challenges in place. Again, how are the managers doing? We see here that they're making good absolute returns. We see that they're beating the market. The next slide really just kind of talks about how they're doing against their peers. And again, we get all excited about these charts, but what you are seeing here is the different columns. If you haven't seen these in the past, we track your managers against their peer groups, so the industry of managers. And what you see is columns for different periods. And the red dot, you have two managers, being Moore, they are your growth manager, and you have Volatile Goodman. I think Rachel talked to these two managers. They are value managers. In the market, there are value stocks and there are growth stocks. So we do believe in a structure that is with risk management in mind, that says don't put all our eggs in one basket, manager's basket, because no managers, are the best all the time. But you can see here clearly in these columns, in each column, if we said there was 100 kids in the class and we want our kids, they all wrote an exam and we wanted them to be in the, at least the top half of the class consistently. And in fact, you're going to see that these managers typically are in the top 25% of the class. You see the red dot, that's Moore. You go left to right, you see the red dot at the top of these charts. They're off the top of the charts over on the left there. And consistently very good against their peers. The purple dot is Volatile Goodman. They're your value manager. Still very, very good. And I will say the markets have been flip-flopping a bit. Over last year, last several years, growth stocks have been very much in vogue. So of course, the growth manager, being Moore, will typically be in a better environment to, do a little bit better in the returns. Value did come in vogue though, and it has certainly since the new year. Growth stocks, the Amazon, Netflix, Googles were getting very expensive, and markets kind of panicked and bailed, and everybody went for the safety of kind of value stocks. And we're seeing Volatile coming on strong in the new year as well. So, but value has been a bit out of favor, but again, they flip flop. And that's again, so are we making enough money? Yeah, 10% return, great. Are we beating the benchmark? Great. Are we the managers that we hired a few years ago, are they still some of the best out there? Yes, and that's good. And I'll leave it at that. And at this point, hey, Kane, 2022, what's going on out there?
Awesome, thanks, Jack. So obviously, Jack just spoke about leading up to 2021 and how good the performance was. And even in 2022, I'm going to talk a little bit about the challenges that we're seeing now. But both Volatile and Moore, if we compare them to their respective styles in their peer group, Volatile is still on pace or outperforming other value managers. And even though growth managers have been beaten up a little bit more than value managers, as Jack spoke to, Moore is still doing quite well when we compare them to other growth managers in the industry. So nothing's broken, but I do want to explain a little bit about what we're seeing in 2022 and why these things are happening in the market and we're seeing these declines. So number one, and I'm sure everyone has heard of this in the news, is the extremely high inflation numbers that we're seeing. So in Canada and the United States, it's been up there in that 8 to 9% range just year to date. So inflation has been really high, higher than we've seen in a long time. And that poses a risk to the economy, because if things start getting too expensive, individuals are going to stop spending as much money, and they also, their disposable income that they can spend on, things that they want to spend and not necessities, that amount of money gets smaller in your pocket. And it's the same for companies as well. So companies have to buy raw materials to manufacture the goods that they make. Those things start to get more expensive. That might slow, their progress and their growth, and then that slows the overall growth of the market, and it impacts earnings, which you can see, obviously inflation is on the left-hand side there, earnings is on the far right. So what's one of the things that the central banks can do is to help combat inflation and make sure it doesn't spiral out of control. They can rise interest rates, right? So that's what we've seen. We've seen interest rate hikes both in the Bank of Canada and the Federal Reserve in the United States and across all sorts of global economies. And that does help to, curb inflation. And the inflation numbers in the United States actually came out yesterday, and it does look like the United States inflation has maybe peaked. It was at about 9.1% over a 12-month period in the month of June, but the July numbers came in at about 8.5%. So inflation has come down a little bit, but when interest rates go up, that has that negative effect on stocks and bonds, because when you value assets, it is based on those overnight interest rates that the banks set. So most of that is just a mathematical equation, but the risk there is that the banks are going to keep rising rates to the point that it's going to lower demand and really slow growth in the economy, right? And it's for the same reason I spoke to you about inflation. Things will just get, too expensive. Cost of borrowing for companies becomes too much, and that could lead to a potential recession. The good thing is earnings for a lot of companies that have reported in 2022, we've now had 2 quarters, and despite being a little bit slower compared to where we were a year ago, a lot of those companies are still posting positive earnings. They're still growing earnings from where they were a year ago, just not at a higher rate that we expected. But there's still earnings, and there's still full employment. Unemployment is extremely low. So those are kind of the things that lead us to believe that even if we do go into a potential recession, it could be short-lived. But that's kind of what's going on in the marketplace and why you're seeing those stocks and bonds kind of fall off in 2022. On page 8, we can see how that impacts the actual trust. And you can see it's a bit of a different picture than Jack painted as at December 31st of 2021. So we have actually fallen off in the second quarter, and over the 1-year period, the trust is down 2.5 million. But it's important to remember that these are unrealized losses. So more and Volatile, they're not locking in those losses. It's the same, portfolio of stocks and bonds that were performing really, really well in 2021. So they're holding these quality stocks and bonds in the portfolio with no plans to sell. It's just riding the wave, if you will, in the market. Markets go up and they go down, and as you can see, it can happen pretty quickly. It can happen in 1 quarter, and it can happen in 2 quarters. But the important part to remember here is just on the right-hand side where we've highlighted. Since inception, we're still up, 2 million, and the transfers out, have been fairly small as at June 30th. So started with about 22 million, sitting closer to 24 million. So we are making money despite going through a period of challenges in the economy. On the next page, we can see, the performance returns in terms of the percentages. And you can see we're actually, despite being down 7.3%, we are outperforming the benchmark by a full 2 percentage points, which is really good outperformance. And you can see that carries over every single period. So over the 1 year, a little bit more of a narrow margin. We're only outperforming by about 0.15%, but we're still beating the market. And over the 3-year and since inception period, which is also 3 years, we are outperforming by almost a full percentage point again. So great performance in up markets, as you saw at the December 2021 date, and also really good performance when markets are down as well, which is also a really important factor. I mentioned that markets can go up and down, and the change can happen quite rapidly. And a lot of this is being driven by people that panic sell in the market, or have a fear of missing out, and want to jump into one of the only positive asset classes in 2022 might have been energy, right? So you might get people selling out of their growth stocks, their tech stocks that Jack mentioned, and trying to pile into energy to chase those returns, and that causes those declines in the market. But you can see how fast things can turn around, and that's why it's important, if you're a long-term investor, to hold. If you're holding quality stocks and bonds in the portfolio, the best thing to do is to hold on to them, because we can see here the year-to-date returns in the middle column. So bonds, for instance, had probably the worst start that they've had in multiple decades, down 12.3% year-to-date. But during the month of July, they actually added about 4% in just 1 month. The S&P 500, which is the third at the bottom there, was down about 18.6% year-to-date, and in the month of July it added 8.7%. So things can turn around very quickly. Just to kind of compare that, I think GIC rates are about 3 to 4% right now, But when you look at this, and that's for the year too, the GIC rates, if you can, be in the stock market already and just hold, you can make 8.7% in a month when things turn around. And when the markets do turn around, fully, and we are past recession fears, and there's, an end to the war in Ukraine, markets will pick up, and that happens, that tends to happen very, very quickly. Page 11 just summarizes, why we don't sell in volatile times. And the average bear market, and a bear market is by definition when markets are down from their most recent high by about 20%. That usually lasts about 12 months. And on the chart here, it's represented by the little small gray area at the bottom. And the average bear market return is about negative 33%. In 2022, we reached about negative 24% at the low in the S&P 500. And you can see here that on the other side, bull markets are just when markets are adding value and they're positive and they're growing. Those tend to last much, much longer. And the average bull market return is about 209%. So essentially, you would triple your money throughout that 85-month period. So you can see here, ideally, if we had a crystal ball that worked, you would want to kind of sell at the peak and buy back down at the bottom, right? But this is almost impossible to do. You might get lucky once or twice, but if you're a long-term investor, it's much easier to just ride the wave, go through the ups and downs in the stock market, and acknowledge the fact that bear markets are a normal part of this. There's no free lunch. That kind of volatility is the price that we pay for the high growth rates that this trust will continue to see over a longer period of time. And those down markets actually present opportunities, buying opportunities for your investment managers as well. And Jack and I have spoken to Volatile and more, and believe us when we say that they are not worried about the companies in their portfolio. They've gone through all of them just like they did during the COVID-19 pandemic, and they still have the utmost confidence in the portfolios that they're holding. So just want to say thanks for your time today, and maybe I'll just give it back to Jack to say thanks as well, and that'll conclude our session.
No, onwards and upwards. And I know we're going to be on the line. Just should you have any questions, we'll be on the line to address any of these concerns. But thank you for allowing us to see again and give you an update. So take care, folks, and onwards and upwards.